I'm Rob Murphy, Head of Investment Trusts at Edison. I'm delighted today to have a great panel of speakers. We're looking at real assets in an uncertain world. Everyone is very aware of the current geopolitical situation, which is having an impact on market volatility, as well as energy markets. And we've got two players in the energy markets today. Plus, there's also the longer term drives and policy drivers towards renewables. And then we've got the macro environment of increasing inflation pretty much worldwide, and rising interest rates and tightening monetary policy. So there's a lot of things going on. And what's interesting is the companies that we're going to speak with today are actually in many ways benefiting from many of these longer term trends and actually proving resilient despite all the troubles that we're seeing out in the market. So we can discover a bit more about what's driving them and how they'll react in various environments. So I'll just introduce the panel. We have first of all Ben Guest, who's Managing Director of New Energy at Gresham House Asset Management, and he's the manager of Gresham House Energy Storage Fund. Also delighted to have Liam Thomas, who's CEO of New Energy Solar, and they manage the US Solar Fund. So we've got basically a battery storage fund, largely focused on the UK, and we've got a US solar fund. And I think actually, Liam, you're also looking at battery storage among your projects as well in looking forward. So welcome everyone, and then to give an angle on the London market, and there's been a lot of money raised in the last year or so, and both primary and secondary. We've got Alex Imseeh from the London Stock Exchange, and he's going to give us a view on how London is in many ways at the centre of the investment we're seeing in the sector. So welcome everybody. So just to kick off then, I mean, maybe we'll start with Ben. So the speakers actually have done a short video. Ben wasn't able to do one, unfortunately. So I think maybe, Ben, you just give a quick 30 seconds on Gresham House Energy Storage, just to give people a quick insight into what the key drivers are of your fund.
Great. Yeah, no, thank you, Rob, and thank you for the opportunity. So I'm specifically here to talk about the Gresham House Energy Storage Fund, nicknamed GRID, as that's the ticker on the London Stock Exchange. It's a company investment trust with a market cap of in the region of £660 million today, operating about 425 megawatts of grid-connected utility-scale energy storage projects, 17 of them at the moment, which are on average going to get larger over time, so will significantly grow with less projects going forwards. Just a sort of anecdotal point, we generated £42 million of EBITDA last year. We're looking to grow the megawatt capacity to about 840 by the end of the year, all publicly stated information, and to grow significantly thereafter with pipeline we've already announced. So strong growth. The need for energy storage is a function of the intermittency of renewables, which emerges as you get more renewable generation and rely on it more. And so the amount that we expect to be needed is significantly greater than the 1.5 gigawatts we've got today. Our focus to date has been in the UK and specifically Great Britain. We do have a first project in our pipeline in Ireland, and just last week we got permission from investors to broaden our reach to 30% outside of Great Britain, which includes Ireland, but crucially includes the US, Europe, Australia and Canada as well going forwards. So it's a broadening of the overall theme. Thank you.
Yeah, so let's kick off the discussion. We're all aware of the need to transition towards renewables. Given what's been happening in the last few months, how do you think the outlook has changed? And I guess anything you're seeing in terms of policymakers, and are they changing, their approach? Is anything being accelerated and so forth? Be interested in any insights you have there.
Who'd like to go first?
Who wants to go? Liam?
I'm happy to start. I think it's interesting for us because we obviously approach this through a slightly different lens. And really, if you look at the UK and Europe versus the US at the moment, things are happening slightly differently. Obviously, the UK and Europe, we've seen huge rises in short to medium power prices because of the nature of the market here, where you still have imported gas setting the price for electricity most of the time. And with the various macro challenges that we have prevailing at the moment, which has caused a real shift in global energy flows, I suppose. And we're in a scenario now where we have the US. The US has just become the largest exporter of LNG, and if current trends continue, that may well continue. And the US has enormously abundant gas reserves, but we haven't seen the same level of pressure on US energy prices, although they have increased significantly. But US energy prices have been a lot lower than UK and European prices a long time because of the shale gas revolution that brought a lot of domestic gas production into the US. So for us, there has been a lot of talk about all of these energy prices, but the reason we started US Solar Fund was to give investors a way to get exposure to the US solar market, which is very large, very well developed, and attracts a lot of institutional participation, but give investors exposure to that without exposure to a lot of short-term power prices. So commonly in the US, solar projects will pre-sell the electricity that they generate for anywhere from 10 all the way up to 30 years. So what you have then is very stable long-term cash flows from the solar project, where effectively whatever you generate on a given day, the off-taker, which is traditionally a large utility, but increasingly corporates, municipalities, educational institutions, they will buy whatever electricity you produce on a daily basis. So that removes that exposure to those short to medium term power prices. What we do have exposure to is in the long term, we have exposure to power prices, because once that initial contract expires, you're free to contract again with that off-taker or with a new off-taker. So I suppose a lot of our investors will hold shares in us, but then they'll also hold shares in some of our peers who have that exposure to short and medium term power prices. So it's been really interesting for us to observe how two markets can behave very differently. And I think a lot of people are watching very closely to see how the US deals with this new position as a very large supplier of LNG, and potentially transitioning to be a key supplier of LNG into Europe.
Yeah, that's a good point. And I'll come back to that volatility angle in a short while. Yeah, I mean, Ben, so what are you seeing out there in terms of changes in policymakers' views on things?
So overall, just in preparing for the answer, I was trying to sort of bring it back to the core basics that I try and put, or lenses or filters that you put things through, and see you know, how they're changing. So you've got costs. It costs the cost of the technology, the competitiveness of the technology. So will people want to invest in renewables on the back of anything that's going on? And then you do have the very strong sort of carbon story, which has, I think, driven down the cost of capital for these sorts of projects for a very long time. And return expectations are very low. And I'll come back to that in the context of the first point. And then you've got energy security. And crucially, that is going to drive, especially in Europe, and keeping it in the European context for now, but possibly in the global context, in due course, an acceleration of the transition. So despite stories around keeping coal on, I think that's just to reduce dependence on gas. I don't think it's to sort of reduce dependence on renewables, as an example.
Yeah.
But going back to the cost point, I think that's an interesting one. Overall, long-term trends are that renewables are also becoming, or are, the most competitive marginal technology. So whatever the mood music is politically, the likelihood is that these technologies dominate, especially if flexibility and other things can help them appear in a sensible way without creating too much instability in the markets. However, we're in a rising rate environment. So marginal projects which don't necessarily, although they do with offshore wind projects, have indexation sort of benefits or linkage, will struggle from, clearly, well, benefit from good PPAs probably for a period, but project costs are going up. Return expectations have not yet gone up as far as I can see, but I can't help think that they will. And I don't know where we end up as a result of all of that, in terms of whether there are any dislocations or whether there's a little turbulence or whether we just crack on and on we go. In the UK context, I am very confident that we're going to see many, many gigawatts emerge from the latest auction round that will result in the majority of our renewable energy story in this country, which will take us well above 50% renewables in the next 5 or so years. I'm very confident of that. It's whether there's any sort of wobbles in other areas which are less contracted or less subsidized. I'll pause there because obviously I could talk for ages on this.
It's interesting, Ben, that you make that point. One of the reasons we really like the US market and solar in particular is because solar is so competitive that it is the cheapest form of new build by some margin, and that gives the industry some resilience against shocks like we're seeing with the potential tariff case in the US, but also with ongoing price rises, equipment price rises, and cost of capital price rises, because the next best alternative to renewables is in the US, gas, and solar and wind, depending on where you are in the US, are the cheapest. And even on an unsubsidized basis are the cheapest. So when you add the benefit of the subsidy in the US, which is the tax credit, they are the cheapest by some margin. So even if, for example, module prices could rise by 10% or steel prices could rise by 10%, and yes, that drives the cost up, which means you need to earn more from your PPA, but it also means that you are still the most competitive form of new build. I'm not sure exactly what's happening in China, but I know it's still a very robust market in the States, and wouldn't be surprised if that's why it remains a hot market despite high module and polysilicon prices and so on, and that obviously gives European investors a bit of or deployers of capital in Europe in that area, not ours, a bit of a headache. So it's interesting how those dynamics actually affect the European dynamics. Absolutely.
No, but I guess, I mean, it's the longer term picture. I mean, that, you know, if the UK is 50% renewables, I mean, the sort of numbers, I guess, are quite huge in terms of, I mean, what are the amounts of investment you see, you know, into renewables, you know, battery storage, what's going to be needed in the next 10 years? And I mean, your own NEV, you said, you know, you're 660 million. I mean, that's not that big a number, I guess, in the context of the amount of investment we're going to see in these areas.
No, I fully agree. I mean, just to give you a rule of thumb, and interested to hear Liam or anyone else's thoughts on this. I tell this to anyone who cares to listen. You know, we have a demand profile on an average basis of about 37 gigawatts in this country. Renewables make up about 40%, but we've got 50 gigawatts of installed capacity, obviously operating at a low load factor because we've got lots of solar and lots of onshore wind, as well as a bit of offshore wind and a bit of biomass, which is actually very high load factor. But incrementally, we've got at least 15 gigawatts of offshore wind coming on in the next 5 years or so as a function of the last auction round and the one that's occurring right now, which will be at 50% capacity factors. So in terms of actual renewable generation, we're going to sail through 50%. Now, if that renewable generation in the UK, it varies depending on the generation mix of technologies and the weather in any country or region. But if in the UK, renewables can broadly generate twice as much as you need or zero at the extremes, then, you know, if demand is 37 today and going to 50 because we've electrified cars and some of our heating and maybe even higher thereafter, you know, we're going to probably need 40 to 50 gigawatts of batteries, right? Because the extreme scenarios where we've got to literally plug the whole gap. because nuclear is mostly decommissioning over the next 10 years, not commissioning, and then coal's gone away and gas is shrinking. So we're going to need an awful lot of batteries, and much more than what we have today. We're at 1.5 as an installed capacity in this country. 20, 30, 40 gigawatts in due course. We've been pounding the table about a minimum of 10 by 2025 since our IPO, and we stand by that still. So it gives you an idea. Yeah. And assume about 500,000 a megawatt or more, depending on the battery duration, as a rule of thumb.
That's all big numbers. Liam,
the US is a big market. Some more big numbers for you. So the US is obviously a huge market, and to put it into context, just through retirement of existing generation, the US needs to build about over 30 gigawatts of new generation every year just to replace retirement. So that's before any increase in demand because of electrification of end use. So you overlay increasing demand because of that electrification and ongoing economic growth, and it's an enormous market. So current expectations are that there will be about 172 gigawatts of solar built just in the next 5 years, so 2022 through 2027. Currently, the market's building between 15 and 20 gigawatts a year, and that's expected to double. And if you work on about $1 million a megawatt or $1 billion a gigawatt, that's $172 billion of solar that's expected to be built over the next 5 years. We're a $300 million market cap. It's going to require an enormous amount of capital, and we're seeing enormous development activity across the US. There's still a big concentration of projects in Texas, in California, and other states that are further along with their renewable journey, because some of this demand is driven by state-based renewable targets, but by far the biggest driver of it is voluntary procurement. So, and what I mean by voluntary procurement is largely utilities looking at the decision about what to replace retiring capacity with or what to meet increasing demand with. And so you have these huge US utilities, and some of them certainly have well-documented desires and plans to decarbonise, but even those that don't are making purely economic decisions. And to put it in simple terms, I have a coal unit that's retiring, it's reaching the end of its life. I can build a new coal unit, but I will need to earn, on average, north of $100 a megawatt hour from that unit over its life for me to make a return on my capital and cover my operating costs. Or I can go out and either build or contract with a blend of gas, solar, wind, and increasingly storage. And I only need to earn, on average, over the life of those of that bucket of generators, $50 or $60 a megawatt hour. The big swing factor is how much storage do I need? Obviously, the more storage you add at the moment, the more you need to earn on average. But again, you've got that big buffer between that blend of gas, solar, wind, and the next, the like-for-like replacement of an aging coal unit. So we're talking huge numbers in the US, and I think those numbers will only increase depending on the path forward for more aggressive renewable legislation supporting the build out of these technologies in the US. Obviously, there was a little stumble in terms of the Biden administration's agenda with Build Back Better, but I think there is growing confidence that some of the climate-specific elements of that legislation will pass, and their path will be smoother than when they were bundled with a whole lot of other infrastructure provisions.
Yeah, I think everyone's realising that, even just from a climate change point of view and what's been going on there as well, is that, the faster we move, the better. And I guess, from an investor point of view, just your point and Ben's on the it's just the cheapest. It's the cheapest supplier of energy effectively right now. So, maybe go on to the inflation side of things. And you partly addressed that, Liam, because I guess the way to look at your company is effect it's, we're going to have volatility in economies and markets and things, but I guess your company is structurally positioned to be just a very stable company. So you've hedged out the power price, and I think curtailment's generally a lower risk for you guys. Is that fair? That's kind of accounted for as well?
Yeah.
I mean, maybe you can just explain curtailment for listeners who don't know what that is.
Sure. Curtailment is when, as a renewable generator, you have variable levels of generation, and in fact, all generation can be curtailed. But you have a system operator who is managing the whole electrical grid, balancing supply and demand, and ensuring the safety of that grid day to day, and making sure that when you plug your appliances in at home, they are running on the appropriate voltage and the appropriate frequency. And so that, for a grid operator, is a task that they're doing every minute of every day. And renewables do increase the challenge because of their intermittency, which is obviously where Ben's storage infrastructure is particularly important, because not only can storage balance supply and demand on an hourly basis, so storing energy generated by solar to be discharged later, but storage can obviously also play a part in managing stability of the system. So you have a system operator who can say, well, okay, we're oversupplied with solar at the moment. The supply of solar or wind is more than demand, so they direct individual plants to curtail their output, so to limit their output, which, depending on the market that you're in, it can be a big risk for renewable generators. And there's, for example, in California, depending on the structure of your PPA, if you're exposed to that curtailment risk, it can mean that on any given day, perhaps you're only generating 50% of your potential. The benefit of the way that the majority of our PPAs are structured is that curtailment is limited effectively to safety related curtailment. So for example, if there's a storm and some of the transmission or distribution infrastructure is damaged and it's not physically capable of handling the power, then perhaps you're directed to be curtailed. But the instances of economic curtailment where an off-taker or a system operator is curtailing you because they can make more money by running another generator, that is very limited in our portfolio. And so back to your earlier point, because our prices are fixed in the PPA, so they're either fixed and they're flat for the life of the PPA, or there is a percentage escalator or some sort of schedule of escalation. That means that we have a good level of visibility into what our cash flows will be year on year. And the variable is generation, which for solar generation varies year to year, particularly from a diversified portfolio across a place like the US. It varies within quite a small band. So long-term, stable cash flow from these assets. Obviously, in an environment where inflation is low or declining, that increases the attractiveness of those cash flows. In the part of the cycle where inflation is increasing, that does mean that, for example, if we're currently paying a 5.5% dividend yield and inflation starts running at a lot more than that for a sustained period of time, it can make our cash flows look relatively less attractive. But obviously, everything is cyclical, and there is a long-term exposure to that inflation through the value of the post PPA cash flows. But I think the way a lot of our investors were initially looking at us when we started the fund was the bond yields were very challenged, and people were looking at some sort of additional product where they could get a long-term, strong, stable cash flow, and it's backed by these cash flows from investment-grade counterparties, but also with some sort of renewable or environmental aspect, which is what we're trying to offer. And it's an interesting feature of the US market in that there aren't generally any linkages to to either CPI or RPI. These PPA prices just tend to be flat or escalate with this fixed escalator, whereas in the UK, Canada, Australia, seems to be a Commonwealth thing. It's very common to attach an inflator based on an inflation index to your power purchase agreement prices.
Right, no, that's a good explanation. Thanks. So Ben, I mean, you've had some benefit of inflation, I saw in your last NAV, but there's other things going on as well. So, I mean, maybe you could sort of talk through how inflation's potentially affecting grid.
So it's inflation is a very interesting sort of macro factor for us, and probably for all infrastructure. Starting with the things that most people would be thinking about, and Liam talked to around the revenue line, we benefit very significantly from directly, sort of pound for pound or percentage to pound benefit in inflation in our capacity market contracts, which are about 10% of our revenues, or heading that way, because they start in a lagged fashion versus the projects that are commissioned. But it's quite powerful, because obviously if you get a big bump up in the first year of a 15-year contract, it follows all the way through. So it's very powerful, and it is a very nice sort of support to the revenue profile. We also benefit from a modeling perspective, if I can use that expression, in that we get our, as I think most of our competitors would, even in the renewables side, get their forecast revenues or power curves, as they're called, as real curves, and therefore you then apply inflation to those real curves. So they're basically seen as independent of macro factors, and then you apply the key macro factor, which is inflation. The big question is whether the inflation actually comes through, given that our markets are driven by the volatility of power prices, not necessarily their absolute level. But if in general money has got less valuable, and the price of everything increases, then volatility will be around. Volatility can always take prices down to zero or negative, and so that's a good anchor. And then in terms of the upside, they will head higher if generally everything is worth less and will cost more. So I do think that there's probably a long-term tailwind. It might not be immediately apparent and obvious every year, but there should be a long-term tailwind to these sorts of projects in terms of their revenue level. Obviously, we have inflating costs, but we have circa 80+% margins in our business, so they're not massively impactful, and not all of them are trending upwards. Only things like rent are sort of locked into inflation rates, which are a pretty small subset of our overall costs. And then finally, in terms of growth, obviously there's a lot of inflation in general around commodity prices and other prices. However, there's also a lot of innovation, because it's a new sector, and there's some deflationary trends in energy storage, which, especially energy storage systems as opposed to energy storage used in cars, although I'm sure it's true there as well. I'm just not studying it as much. But system costs are, and to the extent that batteries don't make up 100% of a system cost, you've got other things that go on inside an overall product, and our ability through our own scale to then extract better prices mean that we're managing to offset things, but that's very specific to us. I think most people are suffering pretty significant increases in battery prices. It is cyclical though, and we will see these revert back to a downtrend, and I think it's also going to be true in renewables. There's just such a wish to transition, and only so much mining capacity, other component capacity, and manufacturing capacity that we may see, we are seeing an upcycle in costs. But I do think that net that there is a downtrend in the cost of equipment in these sectors. There's innovation.
Yeah, that's a good point. I suppose we've seen interest rates rise somewhat, but they haven't sort of gone up massively. And I mean, obviously, people look at the NAVs of both your funds, and a discount rate is obviously a major input into that. I mean, maybe how much do rates have to move, do you think, to change assumptions on your discount rates?
You go, Liam, please.
I was going to say, so the US rates have been rising for a while now, and our valuation methodology takes into account a risk-free rate, and then an asset-specific risk premium. And so what we've seen in the sector, not just us, but others as well, is as risk-free rates have increased, we have seen those asset risk premiums compress. So our discount rates have been relatively steady despite increasing interest rates. And then, as I mentioned before, increasing interest rates will eventually be factored into long-term electricity price forecasts as well, because you have these forecasters who are modelling, well, what is the cost of replacing generation infrastructure, building new generation infrastructure, and the cost of money is an important factor in deriving what the market price for electricity will be. That's not a perfect hedge for rising discount rates, but it does provide a partial hedge. If you increase the discount rate, but you also increase the value of your expected future cash flows, you're not taking the full brunt of the rise in interest rates. So to date, we've seen our blended discount rate for the portfolio be relatively stable, but we are keenly watching where interest rates are. The other thing to mention for us is we do use leverage in the portfolio, and so we look at interest rates in the context of, well, what is the price of debt. But the way we have traditionally financed the portfolio is to hedge out any base interest rate risk for the full term of the debt. So you hedge out that whole period at the time that you take out the debt, and obviously in a rising interest rate environment, that hedged debt looks more and more attractive. So we've been doing this now for a few years across a number of funds, and for the last few years, it always looked like the debt that we put in place in 2017 and 2018 was very expensive, and now interest rates have risen such that the debt costs are almost up to where they were back then.
Yeah, I think that's a good point, because actually in an inflation environment, yeah, if you've got some leverage, that can be a good thing if you've termed it out enough. And Ben, you did the same thing. I mean, you took on some debt a few months ago, and that's helped you obviously build your pipeline.
It's helped us build our pipeline, and there's obviously the side benefit of having debt committed but not drawn, and the avoidance of equity issuance, obviously helping avoid cash drag as a separate point, but is a debt related. In terms of discount rates, we use a pretty high discount rate compared to most of our peers, broader peers, or broader list of peers, at over 10% still. So interest rates would probably have to go up quite a bit to sort of really make the equity risk premium look uncomfortable. So in terms of that going up, but there's always a risk of that happening, and rates are certainly very, very negative. Real rates are still very negative. So be interesting to see how that all plays out, and what needs to happen to bring real rates back to positive territory, whether we actually see inflation come back down, which is possible, subject to geopolitical situation stabilizing, or through higher rates. We'll see. Yeah,
great. I mean, maybe so. We've talked a lot about your specific companies, but we have touched on the investor demand and the required the size of the investment required in these markets. I mean, Alex, maybe we bring you in a bit here, because obviously the LSE, if I went back a few years, there weren't many companies on the AIC renewables renewable infrastructure list, and I think we've got nearly 20 or something now. So there's been quite a big change. I mean, maybe you could talk through what have been the drivers around people looking to raise capital in London on the London Stock Exchange.
Yeah, sure. I think from discussion that we're having, one of the interesting elements that come into our discussion is that, at the London Stock Exchange, we don't do a technical listing. We don't have a technical listing. We provide a market where, the funds can be traded. And we exist basically to bring together those who have capital with those who need capital in service of an objective. And we've got free float requirements on the stock exchange on both markets. And this is to ensure that there is sufficient number of registered holders in the securities to ensure that there is an orderly market. And this is one of the interesting aspects that we have on the stock exchange. Some of the managers that want to launch, they want to bring private assets into the public markets, and the investment trust structure is the perfect structure for that. Obviously, the investments trust structure is more kind of suitable for illiquid strategies, unlike open-end funds. And this is, where we see kind of demand from asset managers. This is why they kind of come to London. The other reason that has come up in conversation is some of them, they look for a permanent source of capital, for example, unlike private funds, where the project would run from 5 to 10 years. A fund manager kind of can concentrate on a long-term strategy without having to kind of, it doesn't have a fixed duration. They can go to the market and raise further capital and grow their fund. So that element of being able to grow your fund and not having to return the capital after 5 to 10 years, that's one of the attractive kind of elements of the stock exchange. And this is why they kind of list on the market. I looked at, there's lots of obviously discussions around liquidity, and yes, funds are less liquid. They tend to be less liquid than listed companies, but equally, they are an investment kind of vehicle. People invest in them for the long term. So you would expect that they are a bit less liquid, but what is beneficial is that investors, whether they're retail or professional, if they want to get out from their position, they're able to get out from their position. If they want to buy in, they can buy in by just clicking a button. And this is really kind of one of the merits of our markets.
Right. And so, I mean, maybe you can talk about the issuance we've seen, primary and secondary last year, and obviously it's a more difficult market this year, I guess, but it'd be interesting what you're seeing currently.
Well, last year it's been a record year for the London Stock Exchange. We've had around 21 billion was raised in total between IPOs and follow-ons. And I would say 1/4 was from IPO, and the other 75%, 3/4 was from follow-on issuances. The fundraising, though, has been led by the renewable energy infrastructure sector, and around 30% from both of the capital, from the IPO and the follow-ons, is coming from renewable kind of strategies, sustainable strategies, let's say. So, for example, last year we had the largest issuance ever for a listed green fund on the stock exchange from Greencoat UK Wind. It raised 600 million. And coming to this year, the market has been a bit slower. Unfortunately, we haven't had any IPO yet. Obviously, this is just because there's been a slowdown from inflation, expectation of inflation, the geopolitical risks. I think there's a bit of shift between of capital going into value strategies and into income generating strategies from growth strategies. And so we haven't seen launches yet. But I would say this year we had 3 billion on follow-on capital raised in general in total, and around 25 to 30% is coming from the renewable energy infrastructure sector. So it is leading the capital raise on the stock exchange. One of the other things that I've been kind of observing the discussion that we're having with asset managers and banks is that there is a bit of saturation on strategies, and for new strategies to come and launch in the market, they'd have to be differentiated because there is already 34 funds on the stock exchange accredited with the green economy mark. So if a new fund would like to launch, they'd have to have a differentiated strategy. I would say the minimum size of kind of that would be acceptable to pull it through would be around $150 if they're looking to launch strategies. And last year we saw the emergence of new asset classes. For example, we had the first hydrogen fund which invests in clean hydrogen coming to the stock exchange. not so much investing in real assets like the topic of today, but it's kind of more of a private equity fund. Then we had a fund dedicated to forestry and afforestation, the Foresight Sustainable Forestry Company coming to the stock exchange, which will invest predominantly in the UK. Another strategy that we haven't seen before coming to the stock exchange is the sustainable energy infrastructure in fast-growing economies from the global south. We saw Thomas Lloyd Energy Impact Trust raising just above 100 million USD dollars, and they're going to invest in projects in solar and biomass in India, Indonesia, Vietnam, and others in the global south. So we see, in summary, it says, these strategies are a key driver of capital raise, both on IPOs and in follow-ons. And the other thing, the trend that we see is that, we see new strategies coming to the market because the funds which pre-exist already serve the market, and investors prefer to go into larger and more liquid funds rather than to go into a similar strategy which is just launching on the stock exchange.
So this year it sounds like we should see probably more secondary from existing players, because everyone seems to have pipelines, and if the primary market's a bit tougher in the shorter term, because I guess you've got numbers, but most of the companies are trading pretty well, delivering kind of solid numbers and trading small premiums on average, probably.
And we need to look at the market a little bit. If we look at the London Stock Exchange, we have 34 funds accredited with the green economy mark. The top 5 account for 55% of the total market cap, and the top 10 account to 75% of the total market cap. So pretty much the performance of the sector on the London Stock Exchange kind of is driven by the top 10 funds. So luckily this year, I think the sector has been performing well. It's trading at I asked the analytics team to look at the sector, the green economy mark funds. They are trading at a weighted average premium of 5.2% as of yesterday. And there has been a positive total return as well, year to date, with an average, I think, 5.8%. So it is a sector which is doing well. And it did well, it's doing well this year, but it also did well last year, when energy prices were kind of lower. So it's attracting investors. It's attracting investors to the sector. Yeah.
I mean, you mentioned the green economy mark. I mean, is that your main sort of way of sort of improving visibility for the funds? And maybe you could say a little bit about it and what it does.
Sure. The green economy mark was launched to kind of increase the visibility of listed companies, but also funds which are listed on the stock exchange, which are kind of achieving positive environmental objective, kind of to recognize them, such as climate change mitigation and adaptation, waste and pollution prevention, and transition to the circular economy. So we've seen a push from kind of regulators and policymakers and standard setters to ensure that investors can determine and identify investments that are genuinely sustainable. And we spotted the opportunity. So we came up with the green economy mark. So the mark kind of focuses on the E element of the ESG, and it uses FTSE Russell's green revenue data model. So it's a proprietary model. And what does that model is, what it does, it has a threshold. And if the fund is, or the company is kind of generating 50% or more of its revenue from green products, then they are added and they're given the green economy mark. So I think it's very, very beneficial because investors that are looking to invest, they can easily get a list of the of funds which are accredited with the green economy mark, and they know that there is behind it the IP and a process which kind of proves that 50% or more of their revenues are produced by green kind of products. So today I think as we speak now, we have around 34 funds accredited with the green economy mark with a total market cap of 25 billion. And hopefully we will see this growing in the next few years.
Great. I'm sort of conscious of time. I mean, if people have any questions, you can submit those through the chat function. So we'll just wait a minute and see if there's any questions to come through. We've covered quite a bit of ground. I mean, maybe just while we're waiting, if anything else comes through, just a question on just US battery storage, because Ben, you mentioned you've recently changed your mandate to be able to look at other markets. And Liam, you're also, you know, looking to do more there. So maybe start with Liam. I mean, what do you think the potential return enhancement might be if you know adding this around your kind of existing projects?
You're gonna love my answer, which is it depends. The US is such a great market in terms of scale and diversity, but it also means that when you're looking at the US electricity market, you're actually looking at many different markets that are all connected, but there are different regulatory structures in almost every state of the US, and you have different wholesale electricity markets with different regulatory structures, and then you have states with their own energy policy. So you look at Texas, for example, it's a completely deregulated market compared to North Carolina, which is a big solar state where the market is still completely it's a completely vertically integrated market, and it's regulated. So you have the same company that you buy as a residential or commercial or industrial customer, you buy your electricity from the same company that owns all of the transmission and distribution infrastructure, and that company also owns a lot of generation and then contracts with independent power producers like us to buy the electricity from us, which they then on sell. So there's no regularly traded wholesale market. The reason I describe that is because that impacts what you can do with battery storage. So if you're building it behind the meter, so if I have a warehouse and it has solar on the roof and I would like to put in some storage to store that energy the electricity that I generate during the day for later use, that's fine. I can do that behind the meter. I do that on my own balance sheet as the owner of that property, great. If you want to invest in grid connected storage, you need to obviously fit within the regulatory construct that exists. So California, for example, there's a lot of storage that's gone into California to balance the enormous amount of renewables that have gone into California, highest penetration of renewables in the US. And so there is a market in California for grid-connected battery storage. But if I look in North Carolina, where we have a lot of assets and it's still completely vertically integrated, it's really up to asset owners like us to come up with a strategy for retrofitting battery storage onto existing assets, which is really that's the lens that I look at storage through at the moment. We have a portfolio of assets. There is the potential to enhance those with battery storage, but it obviously needs to be taken to the monopoly utility because it really, in order to earn revenue, in order to get them to pay you to install these batteries, you need to be solving a problem for them. So that's part of the work that we're doing at the moment, is looking across the portfolio and figuring out, well, what will the model be? And depending on which state we're in 4 states with US Solar Fund at the moment. Depending on which state you are, that model could be quite different. If I then look forward, a lot of projects that we're seeing now, whereas traditionally it was standalone solar, so solar generation only, no battery storage, a lot more projects are coming to us from developers now with co-located storage built with them. So storage is built at the same time as the solar, and sometimes the PPA is even bundled together. So the off-taker pays one tariff, and there's an agreed profile of generation and charge and discharge, and it's all bundled together. And we would really evaluate any investment in storage on the same basis that we do an investment in standalone solar. Who is the counterparty? What is their credit? And then what are the operating risks associated with the storage? Because I'm sure, as Ben will describe much in a much more detailed fashion than me, you can have a battery here and an identical battery here And depending on the way that you operate those, they can have very different risk profiles. And so that's very important particularly if you're building storage for an off-taker. What do they want to do with it? When do they want to charge it? When do they want to discharge it? How many times a day, etc.
Yeah. And then anything you do will then be within the sort of in the same kind of mold as what you currently do. So you'll be looking for a very kind of hedged exposure. Is that the way we should think about it?
That's right. Predominantly, I mean, we have the ability to look at partially contracted or some uncontracted assets, but the strategy would still be mainly directed towards long-term contracted cash flows from battery storage.
Right, that's clear. Ben, I think you've got 5 minutes before we have to close.
Yeah, I can be brief. We are looking at the US as well, obviously. It's early days for us, so much less experience in this market than Liam, but aware of the different regulatory structures and the degree to which markets are influenced, some might say distorted, by ITCs in California, or the exact opposite, and sort of a free market system in Texas, which are the sort of two markets where most batteries have been invested in so far. And by Texas, I actually mean what's called the ERCOT ISO, which captures it a bit more than just Texas. And we're looking at both of those, and but by and large, we don't have established assets that we're trying to add value to, which already have well-contracted, mostly solar technology, for example. We would be going in to install front-of-meter batteries in the same way that we do in the UK. We think that what we do in the UK, or GB at the moment, but it's incrementally in Ireland, is exportable to other markets, and so it doesn't just cover the US, but wherever we do see, crucially to what Liam said, a wholesale market structure where volatility can play a part, or does play a part in markets in a sustainable way, then we can replicate, as long as the technology mix, the amount of renewables, and the weather patterns are, conducive to the need to solve intermittency. That means that there's a case for energy storage in other markets. It's quite different for looking for long-term bilateral contracts with the ISO, for example, the system operator. We would absolutely look at that, but at a point of entry, or more importantly, even at the point of considering it part of the investable universe, we want that to be true. And that means that there's an underlying business model that is merchant, but that we have got comfortable with, our investors have got comfortable with, and see the benefits of, which is fundamentally very profitable, even if there is uncertainty around the absolute level of revenues. That's how we're approaching and screening markets, including the US and different states within it.
And so you think you would see a similar return profile to what you're making in the UK at the moment?
Yeah, absolutely, that would be absolutely the aim. If there's more money to be made in the UK, we'll keep investing in the UK, at the risk of sounding glib. But no, essentially, we do see exciting opportunities abroad, because while our base case is what I've just illustrated, there are opportunities through capacity type agreements, through ancillary services, as we've seen in the UK, and through what is a horrible word in my opinion, but the word nodality starts to emerge. The idea that you can get local pricing as a function of weak grid systems and great distances between the generation and the consumption of electricity, which can be solved for a price, for a premium, by battery storage, which is carefully located in pinch points. So those are upside drivers. And in countries which are much less densely populated, you have much more potential for that, where the grids cost a lot more to maintain.
Australia is a great example of that.
A great example, of course.
Yeah.
Big country. Excellent. Spread out. Yeah.
Brilliant. Well, I think we've run out of time now. I'd like to thank Liam from US Solar Fund, Ben from Gresham House Energy Storage Fund, and Alex from the London Stock Exchange. Thank you very much. It's been I think a very insightful conversation. And for watchers and viewers, we're doing a Renewables 2 tomorrow, which will feature Foresight Solar, Premier Miton Global Renewables, and Thomas Lloyd energy infrastructure. So plenty more to come. And thank you, everyone.
Thank you all.
Thanks for having us. Take care.
Bye.
Thank you so much. Thanks.